Greetings. Today, I thought we would be doing something a little bit different. I have officially began my investment journey into the stock market last year in January, and I would like to do a little recap with you. As a little bit of a warning, this will be a very long video since I will try to put my experiences of an entire year into it. To help you along a bit, I will put disclaimers at the bottom so you will be able to search up different parts. Like if you're only interested in the numbers, you will be able to go there directly. If you're more interested in my story, how we began, how it gradually progressed, then I welcome you to watch the entire video. In general, this video will have around 3 parts. The first part I will go over a general timeline as to how the year progressed, how our mentality changed over our investment, how the strategy formed. In the second part I will show you the numbers, how we did, how the progression of our income grew as months passed. And in the third part I will draw some conclusions about the good, the bad, and the ugly parts of investment and what you should prepare yourself if you begin such a journey. So let's get started, shall we? First, I would like to tell you about how this whole investment thing even began. My father, who's an electrical engineer and an entrepreneur, has been playing around with the stock market since I was very little, so I had some exposure to it through him. However, he too fell into the common trap of thinking that the stock market is really only for the big fish. And although I say it's a trap, there is something to it. In a sense, the more money you have, the safer your investments become and the better opportunities you have on the stock market. However, it's still a trap in a sense that if you consider all 3 facets of investment, one is how much work it requires from you, 2 is how safe it is, and 3 what the expected return is. If you consider all 3 of them together, I would still argue that the stock market is probably the best bet if you have a decent strategy as to how to go about it. But I digress. The main point is that my father switched over to playing Forex, which is a much more volatile market. What I mean by that is that you have a greater profit potential, but in exchange you will have to put in a bit more work to be good at it, and it's much riskier than the stock market. For those unfamiliar with the term, Forex is basically the devisa market, so you bet whether a devisa will increase or decrease in value compared to another devisa. While studying the Forex market, he has learned all the basics and probably went well into the intermediate levels of trading and investing. He did so by studying by himself a lot, playing around, modeled, did all the necessary calculations, and even wrote programs to test out his theories. And as a second part, he has went on plenty of paid and courses. So basically he went to the experts and he also used his brain to kind of rig the game. The usefulness of these courses were pretty much all over the place, so honestly I would probably not really recommend any of you to go pay online courses and anything of the sort, because you never know what you're getting for your money. Probably the only way I would recommend you to undertake such courses would be if you have an acquaintance who has been and has learned a lot from such courses. So you have a trusted source, kind of an insider information, if you will. Although even then you could argue that if you have a friend like that, why not just ask him for the information and spare you the coin? The point is that during these years he has shared basically everything he has learned with me, And as I've gotten older and smarter, I have started taking a bit more part in his trading. We started strategizing together, and as I began learning physics and mathematics of a bit of a higher level, I could take part in a bit more into his theories, and we could do mathematical models, for instance, and try to improve his already working, but maybe not as well as they should strategies. During these Forex years, we had many successes and plenty of failures too. The thing about Forex is that you can earn a lot of money real fast, but unfortunately, you can lose a lot of money real fast as well. So there are many, many, many times where we had doubled and tripled our accounts only to eventually lose them from a weird market fluctuation or something. So even though it worked, we made money, it was never, we never felt safe with that investment. It was a very stressful endeavor. So we were always on the lookout to find a way which would make it a bit more safer, if you will. The initial idea of us returning to the stock market came from one of the courses my father undertook in early 2019, if I remember correctly. The idea was nothing very special, it was a strategy based on a buy and hold ish, dividend growth based stock company selection based strategy. Although the outlook of this system promised much greater profits than Forex could, the simplicity and safety of it was really quite enticing. So we did spend the latter half of 2019 kind of entertaining the probability, the prospects, how much income we could generate from it, how useful that would be, how it can grow as time goes on. And we did come up with some pretty decent models which made it seem actually fairly viable as a long-term investment plan. After enough consideration and planning, we have made up our minds, we have found appropriate brokerages, opened our accounts, and have began our investment journey in early on in January in 2020. The first 3 months of investing was kind of a wash. We pretty much just skipped it altogether. We had plans to make a very good strategy for ourselves, make good plans, and thoroughly investigate the stock market before we really went in deep. So initially we thought we would just keep using the strategy my father was given during his course. However, neither of us really trusted it, so neither of us really did anything with it. At the end of the day, it turned out kind of fortunate with how the market crashed, but still, it turned out to be a really slow start. This is where things become really interesting. Right as we were done with our first draft for our plans and strategies and portfolio management, the virus hit and the stock market collapsed. Like basically everything just went downhill, which was fulfilled our deepest desires and deepest fears at the same time. There were two main ways to react to such a situation. One is to lean back and kind of wait it out, because this is a completely unprecedented situation. And the other is to throw caution to the wind and kind of just go in. My father, with his wisdom and experience in the stock market, decided to take the safe and steady approach. So he just sit back and decided to wait until things stabilized a bit. That's a very reasonable approach, since for him this investment plan was something he would rely on in the nearish future. So getting stuck in an unstable market is unacceptable for him. Personally, I went with option 3. Because of my inexperience and my own fears, while I still had the desires to actually begin this investing, since it did look like a really good opportunity, I went with an approach where I would gradually push money into the system. Like, mathematically, that's by far the best approach in any way, kind of the don't time the market thing. So that worked out relatively well. Although if I had been the throw caution to the wind type, I would have made a lot more money, but that would have been a lot riskier, especially since our strategies were still kind of in their baby steps at this point. So we did not have the trust in it yet because it wasn't that well developed at this point. The summer brought with it two things. One, because of the insane rise of the prices, real money started coming into the account, which was weird in a way because only half of the money I initially wanted to invest had already been invested, as I said, doing the small amount incrementally strategy. The second interesting part, that even though our initial strategy wasn't done by now, with our half a year of experience, we have already noticed many areas where we could improve the strategy, and we have also noticed slight inconsistencies and problems with it which we needed to rethink and kind of redesign. By this point, my father has sold his company and I too was on summer break, so we spent an entire month. It was the 7th, I think, July. We spent the entirety of July working on it pretty much full time to build up a new system, an improved system, even build robots to and programs to download data for our company analysis, and to make our day-to-day trading life of getting the prices and so on much easier. This new version of the strategy, which we were done with sometime in August, has been the one we've been using throughout the year. Although, as for the future, the reason why this video is a bit delayed compared to how it should have been at the end of the year was because we were working on, again, a redesign and a big improvement onto it with a whole year worth of experience, which we have successfully done throughout the later stages of December and January. So we will be using a bit improved version of the strategy moving forward. Now, currently this is the Excel we use to track our strategy and portfolio. I could have shown you last year's model to be more authentic, but I like this version a lot more and many improvements have been done, so I kind of decided to just go with this one. As you can see, we have three main graphs on this page, which is the colorful one you can pretty much disregard for this video. That basically just shows the current diversification of my account. For this section of the video, the upper two will be the interesting part. The left one basically shows how much monthly return I have managed to get during this years of investment. It's all after fees and costs, so these are the actual amounts I could have withdrawn from the account without influencing the initial amount I've invested into the portfolio. The second one to the right just basically shows how my yearly salary grew, how I managed to build it over the time passing. So basically at the end point, this shows that over the year I have managed to gather $4,500, a bit over, dollars. So this would have been my salary if I had just withdrawn the money I have earned. The third important part on this page would be the data row. This has all the valuable informations about the account. For instance, you have the portfolio value that basically shows how the whole thing is worth right now. So there's the market value, which shows that if I sold out of everything I have and just wanted to withdraw all of the money right now, then this is how much I would get for it. The cash, this shows how much money I have in cash right now, so not invested. The deposit, this shows how much money I initially put into this account. Withdrawal would show if I had withdrawn money, which I did not. This shows all the income I have created on the account. This shows the costs, and a simple subtraction will show you that the net income will show the money I actually made. This is the actual profit, and the capital change will show how much this change is compared to the deposit. So compared to the money I have put into this account, I have made 24%, although that's a bit cheating because January has already been added, but it was around 22%, which I made last year. First, let's go over the monthly return graph. As described, the first few months were pretty much non-existent. I only bought a few companies, that's why there are minuses. With my brokerage, there's actually a cost with buying and selling companies, which is why these negatives are there. I did absolutely nothing in February, that's why there's no minuses there. I didn't buy anything, didn't sell anything. I did have $3.77 in dividend. That's why that's a positive. Every other month, even though some dividend income came in, I did not sell anything in profit, and I bought a lot, so it just kept remaining in the negative. As stocks recovered, however, you can clearly see how my buying during the third to fifth month have finally begun to pay off. Although there was a strategy shift sometimes in July and early August, that really didn't affect these two towers I have got. So these $2,000 of income came from just the market recovery. So this doesn't have that much to do with the strategy. Although initially, since we planned to do a buy and hold strategy, this would not have happened if I had kept to that. We have added some take profit elements to the strategy, and that allowed this income to grow and push the system forward to allow a much steeper incline in the returns. This build-up of cash and actually growing portfolio resulted in the strategy finally blooming in the 11th, so in November. We finally managed to overcome the previous records, which is actually quite impressive since by now the market has completely recovered, and although there was still a really strong growing trend in the market, it was a much more manageable one. It's not just everything fell down really hard and it was just shot back up. Right now it was a more reasonable, so this is more of a real representation of what the strategy can do every once in a while. And the actual trend had a very nice growth to it, so that's very good for the future. Overall, although it's a bit early to draw these conclusions, this first year have really given me a deeper appreciation for such investments. It seems to provide a relatively safe and steady income, so I do have hope that by the age I turn 40 or something, maybe a bit later, maybe a bit earlier, depending on how much money I can invest into it in the future, I do have hope that it can replace a need for a job. It doesn't necessarily mean that I won't work, but it will give me the opportunity to consider not working. So if I lose my job, it wouldn't influence me much. That's a really big safety net, which these kind of strategies can provide. The activity of playing around with the prices and the companies and our strategy every night has actually become quite a good hobby for me. It might sound a bit weird, but I'm actually found myself looking forward to checking the prices and see how our companies are doing right now and whether I should interact with it somehow. Do I have something to buy or something to sell? So I would actually consider that in the good pile, that the work you actually have to put into it is actually quite fun. Which gets us to the last part. It's actually a relatively low maintenance job. Like, it took a lot of a lot of work to get this thing going, but once we have had the strategy and everything set in stone, it actually doesn't take much to do the earning part. Every night I usually spend like 2 to 10 minutes during the weekdays where I basically download the current prices of the companies we're tracking and check whether there is a company to sell or buy. And if no, in 1 or 2 minutes, I'm done for the night. And that's all the effort it takes. If there is something to buy or sell, then sure, I will do that. That will take a little bit more time, but generally that pairs up with some money coming in, so that's actually just makes the job more exciting in that sense. So for what income it can provide you, it's really, really low maintenance, especially if you consider that although I've never tried, I'm a bit too too much. I look forward to doing this too much, but I honestly believe that you could run this strategy at around 90% efficiency, only checking once a week. That's probably all it would really take. The worst part of investment is pretty much completely the mentality, the psychology that goes into it. I will take both me and my father as an example for this. My father had been under a lot of stress this year, no thanks to the market and how irrationally it behaved throughout the year. It kept him away from investing pretty much completely. Only towards the end, when he understood more of why the market is behaving the way it behaves, and having seen my successes, that he finally managed to get himself to begin investing as well. Which is a bit of a waste, since he could have made so much money if he had gone along with me. On the other hand, I do understand, because as I've said, for him this money may be needed relatively soon, so getting stuck in the market is a real concern, which he had to make considerations for. So I get that. But even now, he actually did quite well with what little he invested, but still the stress he felt from not being able to get himself to invest and not trusting the market, even though deep down he knew that he probably should use his money, that's really hard to get around with. And this is a fear every single person who have invested or will invest will encounter at one point or the other. On the other hand, my problem was quite the opposite. As success started happening, I started making money, I became, let's say, excited about trading. I have became a bit impatient. I started breaking our strategy, and I sold out of companies a bit earlier so I can buy into another one. So basically, as trading has become a hobby, I kind of was looking forward to trading. So I've spent a lot of time just checking companies and see whether, oh, I can sell this one probably, this is quite high, so even though it did not reach the level where it should be sold, I can still sell it and buy another company. We just fell a lot, so that's something I really should do for increased income. Whether that negatively influenced my income level is questionable. I did not check. You should never check, because that will be just another stress for you. But most likely it did, let's be honest. Most likely I lost out on some money because of my impatience. So that's something I will have to deal with going forward. So long story short, be very prepared. Mentality and your psychology will be the biggest obstacle you will ever face in the investment world. There's a reason why people usually tell others that they should always get to know the companies they invest into. In my opinion, this is really not about the knowledge of the company, What it does give you, however, is trust. The only way to kind of defeat your psychology is to have trust in what you do, have trust in your strategy. So, one of the best ways to do that is to understand the company, because the more you get how they make money, how they can grow, the more you will have trust in that company actually achieving that and earning more money and growing, and by proxy giving you more money. However, you can replace that by simply trusting your strategy. Like our strategy uses a lot of companies and we kind of change them as they go. So we don't really analyze the companies too deep once the company selection has already been done, which is a different approach, but I think overall it does the same thing. It will give you the necessary trust into your system that will allow you to begin trading and actually execute your strategy to a decent level. Another big negative are the costs. We really can't forget about those, unfortunately. If you live in the US, however, there are options nowadays with relatively low to maybe even none as far as costs are concerned. For some people living elsewhere, these options are really few and far between, and even if you can find one of them, it's usually really important to do your research before putting your money into that brokerage, because you can really easily end up in a trap. So do your research. That's on the brokerage. That's a side note. The main issue with the fees is that they can really eat into your profit. For me, it took around 30% of my income just went flying out to the brokerage, which is quite a surprising amount. I didn't expect it to be so high. It must be said though that this is, since costs work in a way that the more I trade, the more costs become, the initial stage where I begin investing will always rack up a much greater price in that sense, because I will be buying in with a lot of money at the beginning, which creates really big costs. So as time goes on, this percentages keeps going down, but even then it's still a considerable amount, so it must be considered. This is the part where I can finally whine about how much initial work it took. Both me and my father has worked over months, probably 2 or 3 months worth of full-time work we put into it throughout the year, which is quite a lot, and especially it might even be a bit more if I consider how much work didn't even got used at the end. For instance, my father has created a very extensive database of companies which are tradable on the US market, like thousands and thousands of companies, which in the last revision we just completely did away with and chose that it's just too much of a hassle to use, and most of the companies in it we can't get reliable information from anyway, so we wouldn't trade them ever anyway. So we just threw that out, even though it contained hundreds of hours of work from him. If you are using your own system, you should also be prepared of a fair deal of self-doubt, since it takes years to test an investment strategy properly. You will have to trust your system really hard to actually make do, because you just won't have the necessary information to know beforehand whether your strategy works and how well it works. A little tip there is to always listen to the market, because unlike you, the market is always right. Third, be ready that no matter how well your strategy does, you will always compare yourself to others, and that's usually quite a bad thing, because it's really easy that, okay, I made 20%, so good, I'm so happy, and then the next person comes around who has made 30, 40, 50% during the same amount of time. It's really hard not to feel discouraged by that, but you probably shouldn't. Your strategies have many facets. to them. Risk for one's time, money, all of these really affect the outcome. Like if you have a lot of money, it's really easy to make money. It's really easy to make a lot of money. So in that sense, the amount of money people made doesn't really matter. Percentages much more so, but even still, it's much easier to be safe with a lot of money. As far as safety is concerned, if it's almost always the truth on the stock market that the safer option you choose, the less money you will make. So even though I only made 20% and the other person made 40, their investment plan was probably far riskier than mine. For instance, someone could come along when I'm really proud of my 20% and say that okay, they invested early on this year into and bought Tesla stocks, for instance, with all of their money. And right now, they more than doubled it. So what the hell am I doing putting in all that work? All he did was one trade early on in January, and now he's made 5 times the money I did. And you can feel bad about it, but if you really think about it, he was just very, very lucky. The same way he could have made that money by simply going to a casino, and he would have had the exact same chance of achieving that success by putting everything he has on, I don't know, red 15. That might not even be a red number, doesn't really matter. The main point is that he could have just as easily lost everything he had if people had realized that Tesla is barely a company, although it has unfortunately becoming more and more so a company. But still, it's more of an idea, and as ideas come, they can go just as easily. So unfortunately, I feel like that companies like that provide a really great growth short term are usually very risky. Especially, you should never put all of your money into one company, because one company can fail really easily. 50 company, that takes a lot to make 50 company fail. So yes, I only made 20% of what he made. I still feel better about my strategy because overall my strategy will work better long term, and even if not, I can sleep better. I should be able to sleep better at least. For those of you who need a little bit of a proof in their life, just to check that my Excel is actually contains the right information, this here is my brokerage, and here you can check that in 2020 during April I have had the exact same transactions, so you can check these out: the AT&T buy, the KSS dividend, the Verizon buy, the Philip Morris dividend, and so on and so on. So as a little bit of a proof, just to make sure I'm believed that this Excel is working with real data, not just fake, because it would be really easy to just fake some an Excel sheet. The only reason I am using this is because it doesn't really have a proper portfolio, this brokerage. So the Excel is just a far more convenient way to track how we're doing right now. Overall, I thank you for watching this little recap of mine, of what I learned. In the next few weeks, months, I do plan on uploading a lot more, as my university is coming to an end finally. I will have a bit more time to devote to this channel, so I will continue my lectures, and I do plan to do a thorough explanation to my Excel sheet, how it works, how my strategy works, how we have come to it. So that is planned, and I do plan to make monthly updates to how my portfolio is doing. I do have plans when it becomes a bit more stable to make the Excel itself be public, so everyone can just check it out for themselves if you so desire. Overall, thank you very much for watching. I hope all of you a much better year than the previous one was. So have fun out there, and if you have not yet, begin your investment journey this year. Thank you and bye.